Happy Friday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Friday, November 4th, 2022. So we had a bunch of data out of the U.S. economy over the past 24 hours that I wanted to highlight, starting with the services PMI for the month of October. That ticked down 2.3 points to 54.4. Still very robust signs of very robust U.S. economic activity. Don't forget, services sector by some measures is anywhere between 70 to 85% of U.S. GDP, roughly around 70-ish percent of U.S. employment. So still growing quite robust there. A couple of indicators within the services PMI that we got. We had the prices PMI tick up 2 points to 70.7. That's a 2-month high there. And we also had the percentage of respondents reporting slower supplier deliveries. Slower supplier deliveries. And so that ticked up to 18.8%. That's a 2-month high there as well. Those numbers bode ill for next Thursday's core CPI data. So definitely keep that in mind in the context of what we've been talking about for many months now, which is the firming of core inflationary pressure and the pass through from the labor market into inflation. And on that point, we got obviously the October jobs report out this morning. Non-farm payrolls beat, average hourly earnings beat as well, 0.4 month over month versus a Bloomberg consensus estimate of 0.3%. When you look at aggregate labor income, when you productize private payrolls, private sector average hourly earnings, and private sector average weekly hours, you wind up with a 6.6% growth rate of aggregate monthly earnings in the private sector on a 3-month annualized rate of change basis. That's down 110 basis points month over month. Just to remind you that 6.6% is still well above pre-COVID trends. Trends, if you look at it on a 5-year mean, it was right around 4.4%. 10-year mean right around 5.1%. So still very inconsistent with the Fed's price stability mandate. There's some ways to go there in terms of seeing some of these different levers within the labor market sort of get to a level that is more consistent with 2% core inflation. I think we have several months at least to get to that point where 3-month annualized rates of change for some of these various some of these important key indicators for core inflation are really tracking at levels not only consistent with 2% inflation, several quarters down the road on a year-over-year basis, but also below the Fed funds rate, which the debate around how much do these indicators need to get below the Fed funds rate has really gotten kicked off in mass, judging by the FOMC event this Wednesday. Shifting gears to my loan book dashboard, just going down global macro. So dollar, that's still bullish. It's getting near overbought here. So just be aware of that. If you're long the dollar, might be good to be taking profits as well. Had a nice big move on 2 very hawkish signals that we got this week, both out of the QRA quarterly refunding announcement and FOMC. Gold, that's still bearish in the middle of the range. 10-year Treasury, that's bullish on short and medium term perspective. You got upside to 4.25 there, so be aware of that. Is that a lower high relative to the previous spot? Yeah, so that might be. Yeah, so. Actually, not quite. Right around the previous high was. So just be aware of that. S&P, that's bearish from a medium-term perspective, neutral from a short-term perspective. Getting close to oversold there. What's the S&P's lower boundary here? So right around 36.90, got upside to 39.37. But now, as you can tell, as we talked about a couple of days ago, the lower boundary of these probable range is now starting to slope to the downside. That's not what you want to see if you're a dip buyer here, praying for Santa Claus, praying for midterm election hopium, et cetera, all the kind of stuff that people need to see happen to dig them out of the hole that they're in for not managing risk appropriately. NASDAQ is oversold here, bearish from a short-term perspective, or from a medium-term perspective, that's neutral. From a tactical perspective, again, it's deeply oversold in terms of violating the lower boundary of its probable range there. But again, as you can see, that range is now starting to slope to the downside. So wouldn't be in a hurry to be buying the NASDAQ, but maybe it's definitely a decent spot to be covering shorts to the extent you took our advice that the Fed and the QRA were going to be hawkish, as hawkish as the data implied they were going to be. If you're paying attention to the data and not the FinTwit, you're definitely on the right side of all these Fed Treasury moves. No buybacks for you, no dovish pivot for you. We'll see you in Q1. Bitcoin, Ethereum, both bearish from a medium-term perspective, bullish from a short-term signaling perspective, both in the middle of their respective ranges. This was the big moves this morning when I woke up. Shanghai got more unsubstantiated rumors about the great Chinese reopening that everyone's been talking about for about 18 months now, and unfortunately, it is still not happening. In fact, China's National Health Commission confirmed. They basically octupled down on zero COVID this week as well. So we suspect some of this zero COVID hopium to fade in equities. And even if it doesn't fade in equities, the one thing I call out, I actually tweeted about this morning, is that, we're now starting to see some short-term bullish price momentum in crude oil, still bearish from a medium-term signaling perspective. But you can start to see, just on a 3-month basis, the slope of the line starting to flatten out. It's no longer in this, decisive bear market that it had been going back from June all the way through kind of the lows of August, September. This is new. Are the energy markets awakening, yawning and awakening? Because the great Chinese economy is yawning and awakening. Which again, I don't want to mince words. China reopening is very bullish for certain aspects and certain risk aspects in many respects. Not the least of which, through the channel of adding a lot of supply of global GDP back into the matrix, and maybe you're likely to see Chinese easing in terms of monetary and fiscal easing to sort of kickstart that process. We don't think that process has been kickstarted, and nor do we think the process is going to get kickstarted at any time over the near term. COVID is a seasonal virus. You're more than likely going to get more cases of COVID and more lockdowns as we progress into the winter. If anything, you should be expecting China to come out of zero COVID with a plan in place in the spring. But again, markets may move ahead of that, so I don't want to tell markets what to do. I just want to make sure everyone here are paying attention to kind of the sequence of it all as it relates to the timing of some of these catalysts. But the key takeaway here is that if China reopens, it's probably going to be bullish in the short term for risk assets, but you're going to start to see that bullish hopium fade because, again, the return of energy as a risk, as a market risk, is something that I don't think a lot of investors are paying enough attention to, particularly as we get past the midterm elections and the leaning on the SPR. Lastly, just concluding with my global macro dashboard here, got 300 ETFs in here, all representing individual factor exposures, sorted by the odds column to see what's most overbought relative to most oversold. Nothing's overbought this morning. Looking for some oversold signals for you dip buyers out there. A lot of folks need a lot of folks need some upside to happen. So if you're YOLOing and you had a bad year and you want to just YOLO some stuff, YOLO some calls and try to make up some points, Vietnam is oversold for you folks. Go buy Vietnam, the Van Eck Vectors Vietnam ETF. You heard it here, folks. Lever up and buy Vietnam. That is the big trade. If you want a Santa Claus rally, you're levering up and you're buying Vietnam. I don't hear anybody talking to me on Twitter about Vietnam, buying Vietnam. Everybody wants to buy the SPOOs. Everyone wants to buy Bitcoin. Everyone wants to buy I was about to use a bad word, the stuff they were already long at the beginning of the bear market. No, go buy Vietnam. What else we can buy? That everyone's not long here. Sorry, I'm having some fun here with the Elongable dashboard this morning. QQD, nope, next, everyone's long that. QQQ, nope, next, everyone's already long that. Media, I don't hear people talking about dynamic media. This is the Disneys, the PBSs of the world, deeply oversold. Hey, you need the market to rally in the year end. Go buy some dynamic media, PBS. Go buy PBS. This thing's deeply oversold. It's got neutral short-term price momentum. It's bearish, so if it really recovers, it'll squeeze. If you need the market to rally in the year end to have a good year, then go buy stuff that people aren't long that they might have to chase. Don't go buy stuff that like mega cap growth that everybody's already long. Who's not? Raise your hand if you not long Amazon, Apple, Facebook, Netflix, all these big companies that are in this ETF. Raise your hand. I didn't hear anybody get with their hands, or everyone had their hands up, I'm guessing. So just be aware of some of these behavioral dynamics in markets. There's a cohort of market participants that needs the U.S. and global economies to fall off a cliff very quickly so that the Fed pivots and supplies liquidity to the markets. We do not believe that is going to happen, yet anything can happen from the perspective of the behavioral aspect of the trade. There's a lot of people who need a Santa Claus rally to bail them out of what has been a poor year of risk management and not paying attention to some of these key macro catalysts and variables that we talk about in our research and on this program on a regular basis. So with that, Darius Dale having some fun with you this Friday, November 4th, presenting our Macro Minute. Everyone have a wonderful weekend, and we'll catch you back here on Monday. Cheers.